everyone, and welcome back to another episode of Let's Talk Real. I'm your host, Ysmaine, and here with me is my co-host, Kelly. How are you doing, Kelly?
I'm good. How are you?
Very good too, and happy to be back with some good content for our viewers here and listeners. So today we're going to be talking about brokering loans. Is becoming more and more of a thing, especially in this like transitioning market that we are in. And we've been having some questions about it, so we decided to just come up and bring this topic to you guys. And Kelly's going to break it down for us in very, very good detail so you understand what that means, what they are about, why do we even use them, and how they can be beneficial to you guys as a buyer in this real estate market right now. But before that, we're going to do our myth of the day, which is related to our topic of the day. So, the myth is broking loans always cost more than going directly to a bank. And Kelly, tell us if this is the real myth or not and why.
It is definitely a myth. So a lot of times we broker the loans out because it's a better option for our borrowers. So in a lot of cases, it costs less. So, and we'll get into more detail when we go through all the different things. Yes, sometimes brokering it out, depending on the product, it can be more risky. So you are paying more because it's higher risk, but that's why we broker it out, because in my company, we don't like to take that risk under the Sierra name, so to speak, and lots of banks do it too. When I worked for M&T, they brokered out loans as well.
Yeah.
But it's the same type of thing. They don't want to take the risk. So they send it to a broker, and then they do it through the broker. And then that's no risk on us for that. But no, you don't. When we're brokering out loans, it's to benefit the borrower, and it doesn't always cost more to broker out a loan.
Yeah,
for sure.
It's not a for certain thing that's going to be more costly. It's really just an alternative option that can be more beneficial to that client in particular.
Correct. And especially in this market, we're doing that to benefit the borrower versus not.
Yeah.
So
and we're going to get more in detail, and you guys are going to understand exactly what we mean by, trying to assist and benefit borrowers that are trying to get into the real estate and purchase a home right now, or even for like investor borrowers that are looking to expand their portfolio and purchase new properties as well. So sometimes going directly to a bank, that bank may not have that big of a range of opportunities and options for that client, but when you broker out, we're really going above and beyond the options that might be available to that particular client. So that's what we're going to get into it. So the first question is going to fall, the first few questions are going to fall under more like trying to access a broader market. So Kelly, how does brokering loans provide access to a broader market compared to traditional lending methods?
So one example of a broader market are first-time home buyers. That's a huge market. And with first-time home buyers, a lot of, young couples, they're actually, first-time home buyer age is much older now than what it was, but first-time home buyers, their credit a lot of times isn't always the best. And brokering out to some of these brokers, they will take credit scores as low as 580, the mid credit score. And that's huge, because when you're young, you're starting to build your credit, but you don't really understand credit. So you're not really understanding how to use your credit. So a lot of kids don't always know how to do it, and their credit score is less than what we can use at our company. The minimum is 620, which is 620 is kind of the minimum across the board for a lot of lenders. But brokering out to these other companies, they can go as low as 680, which helps a lot.
Yeah.
Another piece of reaching out to a broader market is investors or people who are self-employed. We do have some brokers that allow us to use products where if you're self-employed, you show any very common
Yeah.
investors that buy property. And, that's how they make their money. So these other brokers, now these brokers are a little bit higher risk. So you are going to pay a little bit more for these types of loans because, if you don't show any income, but we know you can show income, they have products that they can use that maybe they only need to get bank statements or, we're looking at the returns. They will need at least 2 years. 2 years is the mark, like 2 years of bank statements, 2 years of returns. But these brokers, they just have the products that kind of they can have higher back end ratios that allow us to be able to use them to get these customers a loan. So, but like I said, again, it's a huge help to a broader market, but there is a cost to them. So that's kind of back to the myth where sometimes there's always more
expensive. Yeah, so it depends on the product, right?
It depends on the product.
Yeah.
So we had to the credit score piece of it. We had a client that she was in good standing except for her credit. Everything looked great on paper except for her credit. And her credit was like 583, but we were able to use our broker and we got her a loan, like no problems. Like there were absolutely no issues with her loan. It went through. It was just that middle credit score being a little bit lower than what we could have done at Sierra. So
Gotcha. And I think that kind of falls into the question I had next, like in what ways can lenders like you leverage your broker's network to connect clients with a wider range of loan options? And you kind of like started that already, but you want to kind of continue on that?
Yeah. So it allows, so the brokers, we obviously need to see what they have to offer. Sometimes they offer a little bit more products than what we can. They use a lot of times they have a laundry list of products that they can offer, or they offer pretty much the basics what we offer, but their criteria that allows us to use them, their underwriting criteria isn't quite as strict as ours. Because we don't want to take that risk. So like with the credit score, we won't go below the 620, but they'll go to the 580. The bank statements and the higher debt to income ratios, we don't touch them. But these broker loans do, and they can go pretty high on those back end ratios. They can go up to 60, 70, give or take, depending on the product that they're going into, that allow a lot more flexibility for the customer, as well as how much money they have. So that's the other thing too. The brokers, that they see that, their debt to income ratio may be high, but they have like so much money sitting in their bank statements. So, that's where it helps out with the brokers, because they're like, they have all this cash and they can see where the cash is coming from, in the bank statements, because that's how they prove it, because they can see it coming and going. But that's where it offers that flexibility with being able to market to those customers. Some will take it and some won't. So I've had a few people be like, no, I'm not paying the higher rate. And I've had some where they're okay with it.
Yeah, because that's their only option sometimes. Yeah. Right. And a good example here, and I think I'm going to share one, and then you can kind of expand on that too, of like reaching out to a broader audience. I personally had a client of mine that was an investor, and he already had, properties under his name. But he wanted to add more to it. And then, of course, once you start buying more and more properties, your debt to income ratio is going to go out of whack, because, it's showing so many mortgages under your name or your business name. So that's when like the DSCR loans come in place, or maybe the bank statement options come in place, because sometimes you don't want to use your personal income as a way to approve you. You might want to use the income of a producing property,
Yeah.
or just the bank statements that are coming into your account in order to approve you to purchase a new property. So I had this client particularly go to a broker in order to be able to continue to add properties to their portfolio because they were investor and they were buying rentals.
Mhm.
So that's a way of, pursuing a broker type of loan product, to be able to get something that if you go directly to a loan officer, most likely you wouldn't be able to, because they don't offer that product. So, and not to say that all lenders will not offer. So every lender has different property products, but sometimes the only option might be to go to a broker lender.
Correct.
Yeah.
Sierra is coming out with a DSCR loan.
Oh, that's exciting.
We just had a big conference call this week, and it's in the works. It's not live yet, so they're working out all the bugs to it. But yes, that was actually the first I heard that. So I was like, oh wow, okay. So
awesome. Yeah.
They are coming out. So it'll be interesting to see what their criteria is on it.
Well, so when that comes out, we should do an episode and you can explain all the details to us.
I will have to learn it because DSCR can be very
tricky.
It's very complicated. So I need to study that.
Please do, and then you're going to be our go-to.
Right.
Exactly. So now we're going to fall more into like the cost efficiency side of, potentially brokering out loan products. So how does brokering loans contribute to cost efficiency and for both the lender and the borrower?
So for the lender, we can use their marketing material at no cost to us. And like that's pretty huge because obviously we have all of our marketing material, but there's a cost to that.
Yeah.
Even sometimes to us as the loan officer, if we want to do a mailer or there's certain things that do cost money, or if we want to buy like our Sierra Pacific mugs or, different things like that Sierra Pacific offers, we have to purchase it. Whereas with the brokers, a lot of their marketing material we can use and it's free of charge. Nice. So that's a big savings to us.
For sure.
We also, when we broker a loan, so we do work with us in particular. I'm not sure what other companies do. So my processor, she's still involved with it. So there's still a cost there for us, but they also have their own underwriting. Like we don't underwrite it. They underwrite it. They also process it. And obviously we have to stay on top of it. So our processor works too. So that's another savings because we're not doing the underwriting. We're not doing the paperwork. We're not doing any of that piece of it. Gotcha. So that's where, as a lender, we're saving. Now, as far as the borrower is saving, this goes back to our myth. And I'll just use, one of the brokers right now that we have, their interest rates are just better than ours. There's like, I can quote a customer one of our interest rates and there's always a cost to that. Yeah. But then I'll go look at my broker's interest rates and I can give my borrower the same interest rate at no cost and maybe even sometimes getting money back. So, I just had that with one of yours. I need to relook at her stuff. I forget what her name is, but when I put the loan over into my broker's system just so I could see what the difference was in her interest rate. I could give her the same interest rate at no cost. Gotcha. So that's where, and their closing costs as well are less than ours, which is a lot of times they have set fees for us to charge to the customer. So yes, that's where it's a savings to the borrower because their fees a lot of times are less.
Gotcha. Especially for the most common products like the FHA, the conventionals, the USDA loans that everybody would be potentially using it. The only times probably you're going to see a little more expensive, I would say, would be in the unique type of properties that we just mentioned, like the DSCR or the bank statements, because of the high risk that are involved with those loans.
That is correct. So so there's a savings to both of us. So that's why, again, is beneficial to be able to use a broker for loans for customers.
Okay.
So the other thing too,
Yeah.
our servicing, servicing anywhere isn't always the best.
Oh,
Because
can you first clarify what servicing is? I
yes.
know what you mean, but just so everybody.
No. Yes. So once your loan closes, like I don't have access to it anymore. So we have a couple loan servicers that we use. And of course, everybody always puts their reviews, a bad review out. And unfortunately, that's all people see are the bad reviews with loan servicers. So
people only put a review for loan servicing when they have a problem.
Correct.
Yeah.
So that's the other thing too. I've gotten a few complaints for our loan servicing, and always have to apologize. Our loans get sold, so that's always your loan's probably going to get sold to somebody, and your servicing is going to change.
Yeah.
But I know the loan servicing with a couple of our brokers is better, so that's also another beneficial thing with it
For the buyer. Yeah, and then just to clarify on the selling of the loan thing to the audience that is listening right now. So when you purchase, let's say you use Kelly and Sierra Pacific Mortgage to get your approval, to get your home, you close, you're done, now you're in your home. Yes, it's going to have a servicing company that will take care of like taking in your payments for your mortgage, right? That's what she meant by servicing. But chances are that loan product that you got with Sierra Pacific Mortgage, your mortgage, gets sold to another company. And that's very normal. I would say probably 95% of the lenders out there will do the loan for you and then sell it on the mortgage market. Let's put it that way.
Correct.
I'm getting lamer terms.
The secondary. It's called the secondary market.
Yeah.
So that's how we make our money.
Yeah, exactly. So that's going to happen. Probably 9 times out of 10 it's going to happen unless your bank, in particular, if you work with some other bank, keeps it in-house, which some banks do, but it's very, very far in between when that happens.
Yeah.
So don't be surprised when that does happen. And then you might end up with a different servicer or a different bank within a couple of months or so. So just know that that's very customary. Majority of the lenders will do that, especially local lenders like Sierra Pacific Mortgage. That is very the norm. And one thing to know is that whatever your terms for your mortgage are, they cannot be changed. Correct. So it doesn't matter who buys, which other bank takes over, and that can happen multiple times, by the way. You could have one bank buy your mortgage this year, and the next year another one gets it. So it continues to move on as an investment on the banking world. Mm-hmm. But the terms of your mortgage cannot be changed. So they have to abide by your original, whatever your interest rate was and whatnot, until you decide to refinance or something like it. So just so you guys understand that part, because I think that's interesting that you mentioned, and I just wanted to break it down because a lot of people don't know that, and we do get that question a lot on the closing table, right? And we try to explain that to them. So just so you guys understand that it will happen, your mortgage will be sold more than once probably, but your terms of your mortgage never change unless you refinance it.
Correct.
So, okay. So we have probably already kind of gave an example on that one. So I think we're good to move on to the diversification part of our topic of the day. So on that note, what type of loan products can brokers offer that may not be readily available through traditional lending channels? We mentioned a couple, but if you want to expand on that, go for it.
Yes. Mm-hmm. So I'm going to go back to so I did mention that Sierra is going to start, we are going to have a DSCR loan. It's not yet. I can tell you right now, our perimeters are going to be way more strict than the brokers.
Yeah, for sure. He's always on the risk. He always goes back to the risk.
Correct. Mm-hmm. No doc loans, which means this used to be no income, no asset, and we used to call them NINAs, or there was a couple different types. They are still out there, some of them, where you don't have to provide statements to show. The biggest one is the bank statement one,
Mm-hmm.
that you're not showing tax returns, because in most cases you're not showing any income.
Mm.
However, the bank statements show your income, and we have one of the brokers that we use that offers these products. That's their biggest seller, is that bank statement loan, because they're just looking at the bank statements, 2 years worth of bank statements showing the income coming in and out, and it's legit because they can see the transactions.
Yeah.
So with the no doc loans, I don't really know. You need to have a very good credit score.
Mm-hmm.
I believe you need to show money in the bank. I don't know that they need to see the full bank statement, but it's got to be good credit. They got to have money in the bank, and there's got to be a good reason why that they can pre-approve, or that they can approve them, because these are super high risk. I know the one company that we use that they have them, but I don't know the details of them, because I usually don't touch them with a 10-foot pole because they're too scary for me.
Yeah, so much liability involved on that one.
Correct.
Yeah.
Um,
And I don't think they're very common at all. I mean, the chances of someone qualifying for that type of loan, I mean, they have to have a good substantial amount of money in the bank account for them to do no docs loan, like no question,
correct. Which
no questions.
I'm not even sure how much that is.
Yeah.
I really, like, I know it's a thing with them, but again, I know when we sat in training, I'm just like, I don't want to, like, they're just too risky for me personally.
Yeah. Yeah.
Because M&T used to offer them too back when I worked for them, and I would not. I mean, I did a lot of construction loans. You couldn't use that product for construction loans.
That's right. Yeah.
So, but I mean, yeah, they're too risky. But yeah, the DSCR loans, that's a big one too with investments. You're showing income from the investments that you're purchasing, and that's where there's flexibility in that particular loan type, where if you're constantly buying investments and you're showing that you're making money on each of these investments, they're not going to worry about your back end ratio being, through the roof. So that's where the flexibility is with those borrowers, because that's how they make their money. And, they need these types of loans to be able to buy homes or buy investment properties, or self-employed borrowers. Most self-employed borrowers don't show an income usually.
That's right.
Especially the first few years of being in business. It does take a while. So that's why they're always looking for, a 2-year history, because they want to see that you're starting to make money and that you're continuing to make money. And
if anybody wants to learn more about DSCR loans, please watch our episode 26. We did a whole episode just about DSCR loans, and you guys can go and take a look at that episode and check it out. We went through qualifications, what the requirements are, what does it actually mean, who can or cannot apply for. So if you want to learn more about that specific one, maybe you're looking to start investing in properties, that is definitely a very good type of loan for investors that don't want to use personal income. And you are able to use it even if you are buying your first property. There's a little bit of a requirement there too, bigger down payment and stuff like that, but it's possible. So it is a great way to, start building a portfolio and, being able to finance properties without having to use your personal income. So take a look at that episode 26, all about the DSCR loans.
Yes. So I think that kind of about sums it up for the diversity of that I have, in my history. That's, that
like in the products types and whatnot.
Correct.
And I mean, and you basically explained already, the different situations that they can be used and why we use them. So I think that kind of sums it up. So we fall under now flexibility. And we touched base on this too a couple of times, but just to clarify, So in what ways does brokering loans provide flexibility for both the borrower and the lender?
So the flexibility, so for us, it allows us to be like when we have those borrowers whose credit are too low, ratios are too high, they don't have any money in the bank, they're not showing income, we have any one of those things that we've gone over. That gives us our brokers products give us the flexibility to have a product for our borrowers.
So like in a case where you probably wouldn't be able to help, now with the brokering of the loans, you're able to help a wider audience of clients, right?
Correct. And it really has to do with the underwriting requirements that the brokers have. And, I did go over that, with, the credit scores and the money in the bank, like pretty much kind of sums it up with, flexibility is the reason why we do it. We're able to offer our customers that the same product that we offer, but they have a little bit worse credit score than what I can work with, but our broker can. And, with the DSCR loans and the bank statement loans and the no income, it used to be no income, no asset, or no income showing assets. Like there's all those different underwriting criteria that gives the flexibility for us to help out these customers that may not be able to get a loan otherwise.
And I mean, we had clients between the two of us where one in particular, I believe she had a 580 something credit score, and her back end ratio was higher than the acceptable within Sierra parameters, right? Standards. And then we did end up brokering her out to one of your brokers, and she ended up getting a decent rate, which is actually very competitive to the Sierra. And she was able to qualify for a mortgage that otherwise, with any traditional lender, she wouldn't be able to. So that was pretty interesting to see and be able to help that person that
her interest rate was like, I think, better than what we could have even offered her if her credit score was at 620, if I remember correctly, because I remember looking at it.
It was higher. She would have to pay points to get what she got for free with the broker, and of course she wouldn't even be able to qualify if she went to any lender directly, but because of the broker she was able to. So helping those kind of people, I think, is the most rewarding, because everybody will shut the door, and then with the broker option, we're basically opening a window for these people and giving them a different opportunity there to say, no, yes, you can be a homeowner, you can definitely still buy a home.
The other broker thing, the other flexibility we have, which I just forgot about this. So we do, I believe we have a doctor loan too that we can broker out. I don't know the full criteria on it. I know there is, like, I think the minimum down payment is like 5%. But there is we do have a broker that we use for doctor loans, which is a little bit more beneficial to doctors versus if you're not a doctor. That's why they call it the doctor loan. But there's a lot of doctors.
But I think it has like a list of qualified positions. I think some nurses positions qualify too, right?
Not for this particular one. This is just for doctors. So like if you're a new resident, and you're moving, like that's the kind of the point of it. You're starting in a new hospital and stuff, and it kind of gives them that benefit of that was at my last company that you could do it with the nurses.
Oh, I gotcha. Okay.
So Sierra's is just for doctors. So yeah, but it's out there. I know a couple of our Maryland guys use it because I've asked my boss about it, but I didn't actually need it after I found out we had it. So, but yeah, that
it needs to make sense, right? Sometimes there's an option out there that is designed for doctors, but maybe a product they already have in house may be a better option at that point, because maybe the rate's different or whatever it may be. So,
right.
I think that the good thing for our audience and people that are looking to buy a home to understand is that when you go to Kelly to get a pre-approval, she's gonna look at everything, and she's gonna find the best option for you, for your situation, being going through Sierra, being going through a broker, or whatever it needs to be. That's what she's gonna be looking at. And that's why I love working with her, because the priority for her is not just to sell a product from her company. It's really just to help that client, to the best of your ability. So I love seeing that, and I see that every time. So you coming in, we're talking about broker loans. We're talking about this, reaching out to a broader audience. But in the end, if you come to her, she's just going to do what's the best option for you. And you don't even need to understand where it's coming from. You just need to know that she's going to help you get it no matter what.
Right.
And I think that's the important message to take away is.
Yep. And because I always get a different story than you do.
For sure.
So, I shouldn't say always.
Yeah, sometimes I get more, sometimes you get more.
Right. So sometimes you'll send me somebody and you'll be like, here's a situation. I think they're all good. And then I talk to them and I'm like, yeah,
not all good.
This because that's not quite right. But yeah, that's why I'm here, to fit you into the right bucket.
Yes.
Yeah. If
get the best option for the person. Yeah.
Correct.
Yeah.
So and being able to broker out these loans allows us the flexibility, the different loan products, the cost efficiency, all these things that we're talking about. That's why we do it.
Yeah, exactly. Yeah. And I feel like to kind of go over my last question for you, how does being flexible with loan products and contributing to adapting to our current real estate market? And we kind of dabbled on that a couple of times already, but yeah, cool.
Yep, we did. So this market right now is, this is what I've heard. Mm-hmm. They said the rates are going to kind of stick where they are right now.
Okay.
I'm not listening to them, but
it's kind of hard too, right? It's always changing.
I'm tired of people talking about it because this is where we are. Yeah. But yes, having all this flexibility allows us to offer our customers the products that they fit into. And in this environment, rising rate environment, we need these other options to be able to get it to work for people, because people are always going to be buying houses. It's never going away. Yes, it's slowed down, but it's not going away. And we have to be the ones to be able to alter the way we sell, the way we work with our customers to fit them into what works best for them. Yeah. So that's one of the biggest pieces of it. We want to fit everybody into where they need to be.
Yeah. And real estate is ever changing, especially since COVID is definitely ever changing.
Oh
my gosh. If we can say like, oh, this is today's, and then tomorrow something else already completely. So I feel like having this opportunity to broker loans and offer more options, you just kind of, being able to be flexible and adapting to all the nuances that we see in the real estate market, and within that new changing and, craziness of interest rates and whatnot, you're able to offer more products and more options for people that are still needing the home, that are still needing to buy, that otherwise maybe couldn't or wouldn't be able to qualify through the brokering loans. We're able to still help them, even with the high interest rates or whatnot that we're going through right now. Which honestly, I still stick to say that yes, they are on the higher upper end of the scale, but it's still not high in comparison to what we have seen in the past in the real estate industry. People need to understand that we have seen double digits in interest rates not that long ago. We're talking 2 decades ago at most. So that has happened. And people are still buying houses. People are still, needing to move if they need to move. So it always comes down to, do you need a new home now? So now is the right time. Can you qualify? Great. Can you afford the monthly payments? Great. Forget about the interest rates. If you can buy what you need and you can pay with that cost, that's good to go. Then if the interest rates drop, refinance, talk to Kelly. She will help you get that, fix it up, and then you're going to be even in a better position yet because your monthly payments are going to drop. So just keep that in mind. If you guys need a home, forget about interest rates, forget about the news, paying over.
Don't wait.
Don't wait. Yeah, it's
like that's my biggest advice.
Yes, don't wait.
Don't wait. Like if you're thinking about buying a house, don't wait. Call me, find out what you can qualify.
Where you are now. Yeah.
Only
wait if you have to wait, I would say, right? Only wait if you need to wait.
Correct.
For some reason or another. But if you need a house now and you're able to qualify now, the best time to buy is now, because despite the interest rates, yes, they might drop, they might not drop, they might stay the same for a long time. We don't know. But if you're able to qualify now and you need a house now, it's still cheaper to buy now, because the cost of waiting is going to be always higher no matter what than you buying today, because the market is still rising in price. Like the prices are still going up. We're not on a downward trend of pricing. We have seen maybe like a 1% for a quarter. I think on first quarter, that's what we saw, but then it spiked right back up. We had a 2 point something for the overall on the second quarter. So it's very minimal. It's kind of washed this year. I'm saying about the price, but overall, inflation still goes up every year, no matter what. Taxes still go up every year. So in the end, the cost of waiting is always going to be higher than you buying today. And then interest rates, you can change later. Of course, it would depend on your situation at that point too. Not going to promise that you're going to be able to refinance, because everybody's situation can be different, but that's always an option if you need to, if you want to lower your interest rates for your mortgage.
Yep, I agree.
Yeah. And then is there anything else that you kind of want to leave everybody with before we finalize for today?
Well, like we said, don't wait. But if you're in a situation where you think that you can't buy, call me. We can talk about it. We can see if the information is down below. We can see, if I have a bucket I can fit you into. That's kind of what I want to leave everybody with today. That's why we talked about being able to broker the loans. Yeah. It just gives us more options, more flexibility. So I would say call me if you're interested.
And at least understand how much it would cost you. Understand what the monthly payments would be as of today. Understand the cost, how much you would need.
Or just the process, because it can be very, my job is to make sure it goes as smoothly as possible. But purchasing a home is one of the biggest things you're going to purchase in your life. Yeah. Usually. Sure. Me working with my partners. What's that?
I said, if not the biggest ever, right?
Correct. So yes, and I work with you, my realtor partner, my insurance partners, everybody, to make sure that everything goes through. But when our first conversation, when you're just kind of figuring things out, I go over the process just so you understand, here's where it starts, and then throughout the process, here are the steps till we get to closing. So I would just say, if you're interested, call me. Don't wait.
Don't wait, guys. You heard. So this is it for today. Thank you guys so much for watching another episode of Let's Talk Real. And we look forward to seeing you in the next one. Have a good one. See you guys.
See ya. Happy Thanksgiving.
Happy Thanksgiving.